As of right now, with live trading fully underway on this Thursday afternoon, June 11th, 2026, Lucid Group Inc. is trading at $5.08, marking an intraday push upward of 0.85% on a mixed day for the broader markets. Now that number might look like a small win on your individual brokerage screens, but it hides a massive wedge that is forming between what Wall Street wants to happen and what is actually taking place on the factory floor in Arizona. The immediate insight that almost nobody is tracking right now is not the tiny tick green, but the absolute flood of class action litigation paperwork that hit the federal court systems this week. Multiple heavy-hitter legal firms just consolidated a massive securities fraud lawsuit targeting management over statements made between late February and mid-April regarding their sustainable manufacturing and delivery capabilities. While retail investors are staring at the daily chart waiting for a breakout, institutional desks are calculating the exact legal liabilities of these alleged misrepresentations. This creates an immediate tactical loop. If you are using standard investing sites to track your portfolio, you are probably seeing articles about their high-end luxury models or their cash runway. But the deeper reality is that a company spending hundreds of millions per quarter on research, development, and massive manufacturing footprints cannot afford an extended legal battle that directly challenges its core production data. To find our footing here, we have to establish the common ground of how the market views this name. The prevailing narrative on most online investing platforms is that Lucid Group Inc. is the ultimate luxury survivor. Because they have the multi-billion-dollar backing of the Saudi Public Investment Fund, the general consensus is that they have an infinite cash buffer. Investors look at other struggling startups that are running completely out of gas and assume Lucid is safe simply because they can draw down another billion-dollar credit line whenever things get tight. People treat it like a premium software company waiting for its hardware scaling moment. But the contrarian reality we need to look at is that an infinite cash runway does not matter if the cash burn rate accelerates faster than vehicle deliveries can match. In their last official quarterly report, the company brought in $282.46 million in revenue, missing Wall Street expectations by over 21%. Worse still, their cost of goods sold alone sat at over $594 million. That means before you even count a single dollar spent on marketing, corporate salaries, or designing future platforms, they are losing over $2 for every single dollar of revenue they pull in from selling cars. When you add $335 million in research and development and another $304 million in administrative overhead, the cash burn becomes a gaping hole that even sovereign wealth funds will eventually want to see structural caps on. Let us break down the recent market action, because the technical setup on Robinhood stock trading apps and premium institutional terminals shows a clear picture of exhaustion. The stock has been scraping near its 52-week lows, far removed from the double-digit levels it enjoyed during the initial retail frenzy. Trading volumes have remained stubbornly average, fluctuating around 16 million shares a day, which indicates a massive drop-off in retail momentum. When you look at Tesla stock or Nvidia stock, you see massive daily liquidity driven by high-frequency institutional trading and passionate options volume. Lucid, by contrast, has seen its institutional activity shift towards defensive positioning. Major passive index fund managers like Vanguard Group and BlackRock still hold massive chunks of the equity, simply because the company remains a Russell 1000 component. But active management desks have been quietly de-risking. The price action over the last few sessions reveals a stock that is highly sensitive to any macro pressure. With interest rates remaining a stubborn headwind for high-ticket luxury items, consumer credit profiles are tightening. If an investor goes onto an online investment platform looking for investment help, a fiduciary advisor looking at self-investing strategies is likely going to point out that a $70,000 base luxury sedan faces a shrinking target market in an economy where middle-class buyers are downshifting to hybrids or choosing established giants like Apple stock for tech exposure and sticking to index products like Fidelity ETFs for safety. To truly understand why the recent quarterly miss of 22% on earnings per share matters, we have to look at the massive friction within their actual business model. The company operates as a vertically integrated electric vehicle technology group. They design, develop, build, and distribute premium luxury vehicles directly to consumers, bypassing the traditional dealership model entirely through their own retail network and integrated financial services. Their main crown jewel has always been their proprietary powertrain technology. Their battery packaging efficiency and inverter designs allow them to achieve a driving range that legitimately leaves competitors lagging far behind. They build the flagship Air sedan across multiple trim tiers, ranging from the base Pure model up to the track-ready Sapphire version that commands $250,000. They also recently began manufacturing the highly anticipated Gravity sport utility vehicle at their facility in Casa Grande, Arizona. Beyond their own fleet, they act as a technology supplier, providing advanced powertrain systems to legacy luxury brands like Aston Martin. Comment below how many shares of Lucid Group Inc. you currently hold, or if you are completely avoiding the pure electric vehicle sector this quarter. Looking back at the historical context, this company entered the public markets with an astronomical amount of hype via a special purpose acquisition company merger back in 2021.
The initial expectation set by early management was that they would rapidly scale production to tens of thousands of units within a few short years and launch a direct competitor to mid-size luxury stalwarts by the mid-2020s. The reality of automotive manufacturing proved brutal. Production output for the entirety of 2024 hovered just above 9,000 vehicles. While they met the upper bounds of their own revised, lowered targets, the scale was simply too small to offset the massive capital expenditures required to run a modern automotive assembly plant. They have consistently had to lean on massive capital injections from their majority shareholder, IR Third Investment Company, an affiliate of the Saudi Sovereign Fund, including a massive $1.5 billion liftoff in late 2024, structured through convertible preferred stock and unsecured loans. This historical pattern of relying on equity dilution and external corporate life support to cover billions in annual operating losses is exactly what has broken the trust of traditional Wall Street analysts. When we pivot to the future outlook and map out the potential scenarios, everything anchors back to the tension between narrative expectations and operational reality. The bullish scenario relies entirely on a flawless manufacturing ramp for the Gravity SUV. If the company can successfully deliver those larger utility vehicles into a market segment that traditionally has much higher margins and broader consumer demand than luxury sedans, they could theoretically cut their per-vehicle losses significantly. Furthermore, if their high-efficiency powertrain licensing deals expand to other global legacy automakers who are realizing that building electric platforms from scratch is too expensive, Lucid could pivot into an incredibly high-margin technology vendor. On premium self-investing and intelligent portfolio platforms, that is the option value that keeps the stock from dropping to absolute zero. Conversely, the bearish reality is highly visible and deeply troubling. If the ongoing shareholder class action lawsuits uncover internal communications showing that management knowingly overstated their structural manufacturing improvements earlier this year, it could permanently alienate non-sovereign institutional capital. If retail platforms like SoFi Invest, the Interactive Brokers platform, and Schwab Intelligent Portfolios continue to see capital rotate out of speculative cash-burning automotive equities and into high-yielding cash management accounts or sovereign debt, the liquidity pool for underlying stocks like this will completely dry up. The company cannot survive on technology prestige alone if the underlying equity faces continuous dilution every time the operational account needs another billion-dollar refill. When you sit back and look at the grand architecture of this market setup, the central insight is that this company remains caught in a structural trap. The market expected a lightning-fast technology disruptor that would effortlessly scale to match elite legacy production numbers while retaining high software-like margins. The reality is an incredibly advanced engineering organization tethered to an intensely capital-intensive, slow-moving physical manufacturing business that is losing massive amounts of capital on every single unit shipped. The ongoing friction of missed revenue targets, executive turnover, and intense shareholder litigation presents a massive barrier that a tiny intraday percentage gain cannot mask. For long-term portfolios balancing risk on active trading networks, the corporate narrative of luxury security is facing its hardest reality check yet as execution deadlines loom large against an unforgiving corporate ledger. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Back dollar trackball. Don't forget to like, comment, and share this video to support the channel.